Welcome to our comprehensive XAUUSD market analysis for the week of October 27th to November 1st, 2025. This week marked a critical turning point for gold markets as the precious metal fought to defend the psychologically important $4,000 per ounce level. After reaching an all-time high of $43.81 on October 20th, gold experienced its sharpest sell-off in over a decade, plunging nearly 11% before staging a tentative recovery. The Federal Reserve's October FOMC meeting delivered an expected 25 basis point rate cut, but Chair Powell's less dovish tone initially pressured prices. Despite these headwinds, gold successfully closed the week around $4,003, demonstrating remarkable resilience. Join us as we dive deep into the technical levels, fundamental drivers, and trading strategies for navigating this volatile market environment. The week of October 27th to November first represented a critical inflection point for gold markets. After touching an all-time high of $43.81 per ounce on October 20th, gold experienced an 11% correction, plunging to $38.95 before recovering. The Federal Reserve's FOMC meeting on October 29th and 30th delivered an expected 25 basis point rate cut to a range of 4.5 to 4.75%. However, Fed Chair Jerome Powell's less dovish tone, stating that a December rate cut was, quote, not a foregone conclusion, unquote, triggered selling pressure. Bulls managed to defend the critical $4,000 level by week's end. Gold closed around $4,003, representing a modest weekly gain of 0.8%. Despite the correction from highs, gold's year-to-date performance remains exceptional at plus 52%. Let's examine the week's price action in detail. Gold opened the week at $39.71 per ounce and immediately came under pressure. On Monday, October 27th, prices fell to the opening level as markets struggled to hold $4,000. Tuesday, October 28th, saw gold test $38.95 support, breaking decisively below the $4,000 psychological level. Wednesday, October 29th, was FOMC day. Following the Fed's 25 basis point cut, gold rallied an impressive 3.7% off the lows. Thursday, October 30th, saw continuation as prices pushed back above $4,000, testing $40.76. Friday, October 31st, gold consolidated around the $4,000 level, ultimately closing at $4,003. The week's high reached $40.76, while the low touched $38.95, creating an intraweek range of $181. From a technical perspective, several key levels are now defining gold's price action. On the resistance side, we're watching $40.76, which represents the 38.2% Fibonacci retracement level and immediate resistance. Above that, $41.25 is the key level that would confirm the low is in. $42.00 represents critical confirmation for bulls, while $42.52 would signal uptrend resumption. The ultimate resistance remains the all-time high at $43.81. On the support side, $4,000 is the critical psychological level that gold successfully defended this week. Below that, $3,900 represents major support at the week's low. $38.72 is the 50-day exponential moving average and a critical technical support. Further down, $3,800 is a significant support zone, while $3,700 represents the bullish invalidation level. 5 key fundamental drivers shaped gold's performance this week. First, Federal Reserve monetary policy. The Fed delivered an expected 25 basis point rate cut, but Chair Powell's less dovish tone reduced easing expectations, pressuring gold. Second, U.S.-China trade relations. President Trump expressed optimism about reaching a trade deal with China, and the scheduled Trump-Xi meeting reduced geopolitical risk premium, weighing on safe haven demand. Third, U.S. dollar strength. The dollar rallied post-FOMC as Powell's comments reduced dovish expectations. A stronger dollar makes gold more expensive for international buyers, with correlation at negative 0.7. Fourth, U.S. Treasury yields rose during the week, increasing the opportunity cost of holding non-yielding gold. Fifth, central bank gold purchases continue providing structural support. September saw record ETF inflows of 150 tons, offering a floor under prices during corrections. Market sentiment remains divided among expert analysts. Forex.com's Michael Boutros and James Stanley are cautiously constructive, noting that, quote, bulls stepping in ahead of Fed, unquote, and that the breakout from a descending channel suggests potential for near-term gains. They identify 41.25 as the critical level. Action Forex and FX Pro take a more bearish stance, warning that, quote, the decline in gold has just begun, unquote. They argue the parabolic advance was unsustainable and mean reversion is likely, with targets as low as 3,500 to 3,600. Daily Forex analysts Christopher Lewis and Mahmoud Abdallah adopt a neutral to bearish bias, suggesting the market has probably peaked and expecting rallies to fade unless gold can clear 4,200. The market consensus shows 30% bullish, 40% expecting consolidation, and 30% bearish. Looking at price ranges, we have two distinct timeframes to consider. For the short term, covering the next 1 to 2 weeks, we expect gold to trade in a range of $3,900 to $4,150 per ounce. This range accounts for the market digesting the Fed decision and awaiting fresh catalysts. Key support sits at $3,900 to $3,920, while key resistance is at $4,076 to $4,125. Scenario probabilities show 35% for consolidation, 30% for bullish recovery, and 30% for bearish correction. For the midterm, covering 1 to 3 months, we're looking at a broader range of $3,700 to $4,300. This accounts for a potential consolidation period followed by a directional move based on macro catalysts. Major support is at $3,700 to $3,800, while major resistance sits at $4,200 to $4,300. Let's discuss actionable trading strategies for 3 scenarios. The bullish scenario, with 35% probability, triggers on a break above 41.25. Entry would be at the breakout, with targets at 42,443.26. Stop loss at 40.50. Strategy: wait for confirmed breakout with volume, scale in 50% at breakout, and 50% on pullback. The consolidation scenario, also 35% probability, expects range trading between 3,900 and 4,150. Buy zone is 3,900 to 3,950. Sell zone is 4,100 to 4,150. Use tight stops at 3,850 or 4,200. The bearish scenario, 30% probability, triggers on a break below 3,872. Targets are 3,800 and 3,700 with stop loss at 3,950. Risk management is critical. Position size 2 to 3%, stop loss mandatory, maximum leverage 3 to 1. In conclusion, the $4,000 level has emerged as the critical battleground between bulls and bears. Gold's ability to defend this level, despite multiple headwinds, demonstrates underlying strength in the market. As long as gold holds above $3,700, the long-term uptrend remains intact. The exceptional year-to-date gain of plus 52% reflects strong fundamental support from central bank buying and monetary easing. Short-term, we expect a period of consolidation in the 3,900 to 4,150 range as the market digests recent volatility. Midterm targets over the next 6 to 12 months, assuming gold holds above 4,000 and breaks above 4,200, range from $4,500 to $5,000. Key bullish catalysts include continued Fed rate cuts, central bank accumulation, and geopolitical tensions. Bearish risks include hawkish Fed policy, sustained dollar strength, and technical breaks below 3,700. Thank you for watching.